I'm Danni Hewson, Head of Financial Analysis at AJ Bell, and I'm joined by James Flintoft, Head of Investment Solutions at AJ Bell, and we're going to discuss strategic changes being made to asset allocation in AJ Bell funds for 2025. James, thanks so much for joining us. Can you summarise how you approach changes to asset allocations?
Yeah, there's three major steps really. So we like to review the structure of our asset allocation every year, make sure that we're including assets in the portfolio that really we want exposure to in the long term. So to take forward into our strategic asset allocation process, which we re-optimise every year and then monitor throughout the year. So this year we have made some structural changes to the process. We take that into what's called a strategic asset allocation process, which is based around a mathematical model called a mean variance optimizer. We construct an efficient frontier, select the portfolios from that frontier, which is 6 core asset allocations there. Then we look at those portfolios, try to think about the risk inherent in them, what maybe a model can't see within those portfolios, and think about tactical intervention around the edges. Usually that's with really high conviction ideas, but sometimes it is just really making sure that we fine tune the risk in the portfolio as well.
Can you give us a bit more on the structural changes to the process this year?
Yeah, there's 2 major changes really. So firstly, in the alternatives, we've removed them from the asset allocation process this year. So they were historically infrastructure and property. We feel that actually those 2 asset classes aren't giving you the return dynamics and the diversification that you really want in portfolios over the long term. So we do still consider those asset classes as tactical asset classes. So we will look at them, but we think of them more like equity asset classes because inherently that's what they are. So we don't put them into the optimization process, and we won't do going forwards. Then secondly, we've looked at our emerging market in Asia exposure, and specifically around China. Now China is embedded within those 2 asset classes, and it has been for a number of years. We've decided this year that now is the time to be more transparent and offer greater flexibility with our China positioning. So we've broken those 2 asset classes up into China on its own, emerging markets ex-China, and then a developed market Asia Pacific index to make sure that we've really got that ability to dial up and down the risk in China specifically.
Just some of the major themes then surrounding the revised asset allocation this January.
The major themes really inflation and how that impacts the bond portfolio. We feel that there's some specific vulnerabilities in the UK, but some of those also translate into the US. So in the UK, we're thinking about food and energy inflation, the vulnerabilities we have in terms of importing a lot of that into the UK. And we feel that the market throughout 2024 has perhaps lost sight of what's going on with inflation a little bit because there's been lots of political interference, lots of geopolitical events. So it's come into the background a little bit, it's lost the focus, it's got back to target. So naturally some people aren't looking at it quite as closely. We feel there's maybe a little bit of upside risk building in there. Not necessarily that there's going to be a big overshoot in terms of inflation, but we think there's a potential that markets are a little bit complacent around inflation and we're not being compensated for that risk regarding inflation. So we've wound duration back to make sure that we're not taking too much interest rate risk. So if there is an uptick in inflation, we're not actually getting hit by a long duration positioning should interest rates need to rise, or should indeed markets expect that interest rates need to rise as well. So we've really dialed the risk down in the bond portfolio this year.
Let's talk about equity content now. How has that changed?
We've changed the controls a little bit around this, so we now consider the equity content of each portfolio as a standalone equity portfolio in its own right and think about that risk relative to the global equity index. So we've made some changes to the guardrails around that, so you'll see some changes in the portfolio that relate to that. But broadly speaking, the rotation that we're seeing this year is into Europe because valuations are low, the model likes that. And then into the US, because we've changed some of the guardrails around that, we feel that the portfolios and the optimizer would introduce too much downside risk relative to US markets. So we've just tightened up some of the exposure in the US equity market. And we've also at the same time looked at the concentration within the US market. It's historically concentrated, as are lots of other markets, but specifically in the US, which has performed really well over the last couple of years. We feel that there's risk building. So we've taken the opportunity with the increased allocation to the US this year to introduce just a little bit of equal weight exposure as well, just to dial back that concentration.
Have you made any specific changes to holdings?
A fair few changes there. So there was that iShares S&P 500 equal weight related to the US going in there into the passive portfolios. We've also introduced some synthetic ETFs into portfolios this year for the first time in emerging markets, ex-China and in China. Now we've introduced those because we've assessed the counterparty risk inherent in those types of vehicles relative to what you see in a physical ETF. And actually we've seen that some of the risks are very much the same, if not a little bit better in some of the synthetic products. Because of how the securities lending on a physical product takes place, you are incurring counterparty risk now. Lots of physical products are doing that now because they want to keep costs low, and that's one method of doing so. So the counterparty risk looks very similar with a synthetic ETF. So we've introduced a couple of those because they give us better tracking error relative to the benchmarks that we want to track. On the active side, few different changes. So we've gone emerging markets ex-China. So we've introduced an Invesco fund there as part of that change. In Europe, we've taken the opportunity to assess the blend of funds that we've got there. So we've introduced the BlackRock European Dynamic Fund and the Lightman Fund in Europe as well as part of that blend. The casualty there has been the BlackRock Continental European Income Fund, which, as the name suggests, is an income fund. We've moved that across the income portfolios only and kept the growth portfolios invested in those two new funds for our allocation. Then in China, we've dropped a fund there, the FSSA All China Fund. There's been a reassessment from the research team there. So we've introduced a passive holding in there for the time being in the active and the passive portfolios. And then on a couple of other points around those alternatives, we've removed the Gravis fund that we have in there because obviously we're no longer allocating to that asset class. All these details, line by line, what's going on in the portfolio are available in our broader SAA document that's been released as part of this process, and some of the other material that we've released, so you can study those in finer detail.
Let's end with the outlook then. What sort of market environment are you positioning for?
Yeah, we try not to be too specific with our positioning because ultimately we don't know how markets are going to unfold, but we're just thinking about the risks and the very specific risks in there regarding inflation in the bond markets and then concentration in the US equity market. Now, we don't know how that will pan out, but we're just thinking about the downside risk in the portfolios. We've got a decent history of protecting the portfolios in the bad time. We feel this is another juncture that we could do so. Particularly in the bond market where we've brought duration down, we don't feel like there's any adequate compensation for taking long duration positioning. So when we're not being compensated, just don't take the risk, basically.
James, thank you so much for talking to us, and we look forward to catching up with you and the rest of the team about the fund's performance over 2025.
Thanks, Danni.